Welcome to our deep dive into the stock market, a crucial component of the global economy. Today, we'll break down what happens in the stock market and explain some important terms you need to know. No more jargon, no more confusion, just straight talk about how to navigate the exciting world of investing. So buckle up, get ready to learn, and let's make some money. Because remember, in the stock market, knowledge is power. Let's start with the basics. Shares. Think of a share of stock like a slice of your favorite pie, except instead of apple or cherry, this pie represents a company you believe in. When you buy a share of stock, you're buying a small piece of ownership in that company. Now, why would you want to own a piece of a company? Because when that company does well, its value goes up, and so does the value of your shares. When the company succeeds, you succeed. But here's the exciting part. Owning a share isn't just about hoping the company's value goes up. As a shareholder, you have a voice in the company's direction. You get to vote on important decisions like who sits on the board of directors. That's right, you become more than just an investor. You become part owner. Of course, like any investment, there's risk involved. The company's value can go down as well as up, and there's no guarantee you'll make money. That's why it's crucial to do your research, understand the company's business, and invest wisely. So remember, when you buy a share, you're not just buying a piece of paper, you're buying a piece of a company's future. Now let's move on to another important concept: dividends. Alright, we've covered shares, now let's talk about dividends. Dividends are a fascinating aspect of investing that can provide a steady stream of income. Remember how we said owning a share is like owning a piece of the pie? Well, dividends are like getting a little taste of that pie, a sweet reward for being a loyal shareholder. Dividends are essentially a portion of the company's earnings distributed to shareholders. It's a way for companies to share their success with those who have invested in them. Think of it this way: when a company makes a profit, they have a few options. They can reinvest that profit back into the business, save it for a rainy day, or they can choose to share some of that profit with their shareholders. That's a dividend. Reinvesting profits can help the company grow, leading to potentially higher stock prices in the future. Saving profits can provide a safety net for the company during tough times, ensuring stability. But when they share profits with shareholders, it's like getting a bonus, a thank you from the company for believing in them. Tangible reward for your investment, and the best part is, you don't have to do anything to earn it. Just sit back, relax, and watch the money roll in. Stream that can enhance your financial well-being. Now, not all companies pay dividends. Some companies, especially younger ones, prefer to reinvest all their profits back into the business to fuel growth. And that's okay. It just means payments. This can be particularly true for tech startups and rapidly growing companies. But when a company does pay dividends, it can be a beautiful thing. It's like getting a regular income stream, a passive way to grow your wealth. And over time, those dividends can really add up, compounding your returns and helping you achieve your financial goals. It's a powerful way to build long-term wealth. So keep an eye out for those dividend-paying companies. They can be a great addition to any diversified portfolio, providing both income and growth potential. Remember, dividends are just one piece of the investment puzzle, but they can play a significant role in your overall strategy. So, whether you're looking for income, growth, or a bit of both, dividends can be a valuable tool in your investment arsenal. So keep an eye out for those dividend-paying companies. They can be a great addition to any diversified portfolio. We've talked about shares, we've talked about dividends. Now let's talk about building your financial fortress, your portfolio. This is where all your financial knowledge comes together to create a robust and resilient investment strategy. Think of your portfolio like a delicious smorgasbord, but instead of food, it's filled with different investments, each carefully selected to help you achieve your financial goals. Just as a well-balanced meal provides all the nutrients you need, a well-diversified portfolio offers a balanced approach to growth and security. Now, you wouldn't want to fill your plate with just one type of food, would you? That's why diversification is key. By spreading your investments across various asset classes, you reduce the risk of any single investment negatively impacting your overall portfolio. Just like you wouldn't put all your eggs in one basket, you don't want to put all your money in one stock. Diversification helps protect your investments from market volatility and unexpected downturns. That's where your portfolio comes in. It's a strategic collection of investments designed to work together to achieve your financial objectives. It's all about spreading your risk, diversifying your investments across different asset classes like stocks, bonds, real estate, and more. Each asset class has its own risk and return characteristics, which can help balance your portfolio. This way, if one investment takes a hit, the others can help cushion the blow and keep your portfolio afloat. Diversification acts as a safety net, ensuring that your financial future remains secure. Building a well-diversified portfolio is like constructing a sturdy building. You need a solid foundation to support the structure. You need a strong foundation, which might consist of lower-risk investments like bonds. These provide stability and steady returns. Then you can add some growth potential with stocks, and maybe even sprinkle in some alternative investments for good measure. These can offer higher returns, albeit with higher risk. The key is to find the right mix of investments that aligns with your risk tolerance, time horizon, and financial goals. This personalized approach ensures that your portfolio meets your specific needs. Remember, your portfolio is a reflection of your unique financial situation and goals. There's no one-size-fits-all approach. Tailoring your investments to your personal circumstances is crucial for long-term success. Building a solid portfolio is an ongoing process, but the rewards of a well-diversified investment strategy are well worth the effort. Regularly reviewing and adjusting your portfolio ensures it continues to meet your evolving financial goals. We just talked about portfolios and how important diversification is, but let's dive even deeper into this crucial concept. Remember that old saying, "Don't put all your eggs in one basket"? Well, in the world of investing, that's not just a saying, it's the gospel. Diversification is your shield against the unpredictable swings of the market. It's about spreading your risk, so if one investment goes south, your entire portfolio doesn't go down with it. Think of it like this: if you invest all your money in one company and that company goes bankrupt, you lose everything. But if you spread your investments across different companies, industries, and asset classes, even if one investment fails, the others can help offset those losses. It's like having a safety net for your money. No one can predict the future, and even the most promising investments can take a turn for the worse. But by diversifying, you're essentially hedging your bets, reducing your exposure to any single risk, and increasing your chances of long-term success. Now, diversification isn't just about buying a bunch of different stocks, it's about strategically allocating your assets across different sectors, industries, and even geographies. By spreading your investments wisely, you can weather the inevitable storms of the market and come out stronger on the other side. All right, we've covered a lot of ground, but now it's time to talk about market capitalization, or market cap for short. This is a crucial concept for anyone looking to understand the stock market better. Don't let the fancy term intimidate you, it's actually a pretty simple concept. Once you grasp it, you'll see how it can be a powerful tool in your investment toolkit. Market cap is basically a measure of a company's size in the market, and it's calculated by multiplying the company's share price by the total number of outstanding shares. This gives you a snapshot of the company's overall value. Think of it like this. Imagine you have two pizzas, one small and one large. The size difference is immediately noticeable. The small pizza represents a company with a small market cap, while the large pizza represents a company with a large market cap. It's a simple yet effective analogy. The size of the pizza doesn't necessarily tell you how delicious it is, but it does give you an idea of how much pizza there is to go around. Similarly, market cap gives you an idea of the company's size but not its quality. In the stock market, companies are often categorized by their market cap, small cap, mid cap, and large cap. Each category has its own characteristics and potential. Large cap companies are the big dogs of the market, the blue chip companies with a long history of stable growth. They are often seen as safer investments. Think Apple, Microsoft, Amazon. These are the companies that dominate their industries and often have a global reach. Their influence is vast, and their market cap reflects that. Mid-cap companies are somewhere in between, not quite as massive as the large caps, but still substantial players in their respective markets. They offer a balance of growth potential and stability. They often have more growth potential than large caps, but also come with a bit more risk. This makes them an interesting option for many investors. Small-cap companies are the up-and-comers. the smaller companies with the potential for explosive growth. They are often more volatile but can offer significant returns. Understanding market cap can help you make more informed investment decisions. It provides a framework for comparing companies and assessing their potential in the market. Hold on tight, because we're about to hop on the market roller coaster and talk about bull and bear markets. These terms are thrown around a lot in the financial world, but what do they actually mean? Imagine a bull charging forward with its horns raised high. That's what a bull market feels like. Powerful, optimistic, and full of upward momentum. Stock prices are rising, investors are confident, and everyone's making money. It's a time for growth, expansion, and riding the wave of economic prosperity. Now picture a bear lumbering down, its paws heavy on the ground. That's a bear market. Sluggish, pessimistic, and filled with downward pressure. Stock prices are falling, investors are fearful, and losses are mounting. It's a time for caution, preservation of capital, and waiting for the storm to pass. Bull and bear markets are natural cycles of the market, like the ebb and flow of the tide. They're influenced by a complex interplay of factors, including economic growth, interest rates, investor sentiment, and global events. But here's the good news. Understanding these cycles can help you navigate the market more effectively. During a bull market, it's a time to be aggressive, to invest in growth stocks, and ride the wave of optimism. But during a bear market, it's time to be more cautious, to focus on preserving capital, and seek out value investments that are oversold. Thanks for joining us on this journey through the stock market. Remember, understanding these key terms can help you make more informed investment decisions. Happy investing! We've covered a lot of ground today, from the basics of shares and dividends to the complexities of diversification and market cycles. The more you learn, the more confident you'll become, and the better equipped you'll be to navigate the exciting world of the stock market. Remember, in the stock market, knowledge is power, and the best time to start investing is always today.